welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Hey, just a quick reminder, as usual, there's an important disclaimer at the end of the show that you should listen to. It's time for another FlashCast. Now, if you missed it last month, a FlashCast is a podcast that's short and on a single subject. Now, we've done a couple of these so far, and both have been with the MIB team. Now, as a reminder, the Market Intelligence branch is designed to understand, analyze, and communicate current and emerging derivative market dynamics, liquidity, trends, and developments, such as the impact of new technologies and trading methodologies. Now, for those of you who want to read that research and more, you can get the research the MIB team produces by going to cftc.gov, then click on the Market Data and Analysis button, then click on Staff Reports. Now, not every FlashCast is going to be an MIB person or always someone from the CFTC. But today we actually have someone on from the MIB team. So we're going to bring on CFTC Market Intelligence Branch's Chris Goodenow. Chris is a market analyst in MIB and one of the CFTC staff contributors to the research piece entitled Impact of U.S. Tight Oil on NYMEX WTI Futures. Chris, welcome to CFTC Talks FlashCast.
Thanks, Andy. Happy to be here.
Hey, for our audience, explain what was the driver for creating this piece of research? Why did you do it?
Sure. There's been a lot of talk in recent years about how the growth in U.S. oil production has changed the country, energy policy, economics, trade balance, things of that nature. But from the Commission's perspective, our concern is on what's going on in the futures contract market itself. So I decided to kind of take a look around at our data and see if there were any sort of emerging trends or how things had evolved over time.
Well, how did you go about the research then? I mean, what data sets did you use?
Well, every day, CFTC ingests a substantial amount of market data. Some of it comes from the exchanges themselves, and some of it comes from individual reporting entities. And these are fairly rich data sets, and that's where I chose to sort of begin the analysis. I started with a really broad look at volume and open interest in the NYMEX WTI contract using data that we get every day from the CME group. And then I just started getting more granular, making deeper cuts on the data to see if there are any sort of noteworthy trends. I also pulled a bit of public report data on Brent futures contracts from the Intercontinental Exchange, just purely as a comparison of activity between the two futures contract markets. And then eventually, I wound up combining data that's sent to the Commission by reporting firms with information that comes out of CFTC's Form 40, which comes directly from firms themselves, to see if I could discern any sort of general trends at the trader level based on the categories CFTC publishes in its disaggregated commitment of traders report.
Well, I guess it begs the question, what were the findings?
Well, in summary, there were four main findings of the analysis. The first is that, as a whole, volume and open interest in the NYMEX WTI contract remains robust in the wake of the shale oil boom. Secondly, at a more granular level, open interest in contracts for delivery 5 or more years into the future has declined since U.S. tight oil production took off. Third, based on data available to the general public, data that the Commission collects, and conversations I held with industry participants, the decline in open interest of NYMEX WTI contracts for delivery 5 or more years into the future has been primarily due to structural changes in the underlying physical crude oil market caused by the growth of tight oil production. And then finally, the overall price level changes in the oil market and developments in financial regulation may have had a secondary effect on open interest in the NYMEX contract overall.
Okay. So I guess, was there anything that surprised you about what you found, or anything surprising in some of the commentary that when you had conversations with market participants, anything jump out at you that was just like, wow?
Yeah, actually. The biggest surprise, at least to me, was how quickly long-dated open interest dropped off. So historically in the contract, there's generally been a healthy degree of open interest for contracts that deliver 5 or more years into the future. And if you go back to 2008, there were approximately 46,000 open contracts at one point during the year, which is around 46 million barrels of oil. Now, at the end of March of 2008, which is where we sort of had a pencils down moment in terms of the observation period, there were only 481 open contracts, which is about 481,000 barrels of oil. Now, while oil prices have come down significantly since 2008, prices back in March were about $65 a barrel with about 400 open contracts for December delivery 5 years into the future. And the December contract actually holds most of the long-dated open interest at that point. But back in 2014, when prices were at about $65 a barrel, you had more than 10,000 open December contracts 5 years forward.
Wow.
And if you go back to 2009, there were about 36,000 open contracts for December delivery 5 years forward. So just the dramatic decline, and I hesitate to use the phrase sort of fell off a cliff, but just the rapid pace at which it declined was a little surprising.
That is interesting. Yeah, it's kind of shocking, but it really underscores why it was important to do the research. Okay, let's get the big 50,000 square foot view here, or 50,000 foot view, not square foot view. But what were the major takeaways when you step back and look at your research?
Well, the big sort of takeaway is a lot of times, people sort of wonder about the relationship between futures contracts and the underlying physical markets and how closely they're related. And based on the data analysis that we conducted, there's been a significant reduction in the usage of futures contracts for delivery 5 or more years into the future. And based on the discussions I had with industry participants, that decline seems to be primarily driven by changes in the underlying physical market. So as production from tight oil becomes a larger part of the asset portfolio of oil-producing firms, they necessarily will have less oil to sell 5 or more years forward, which reduces their need to use a long-dated futures contract.
So I guess rephrasing that a little bit is that because tight oil or shale oil gets produced on a much shorter time frame as opposed to like doing a larger project in deep water, which takes a while to ramp up, and then you expect it to produce for a longer period of time, right? And that's why you would use those contracts perhaps to hedge out at a longer date. Now there's just not that need for it.
Right. So generally speaking, you're spot on. Okay. A more traditional oil well does produce oil for a much longer period of time, whereas an individual tight oil well, you get a lot of the oil back a lot sooner.
Okay. Yeah. Okay. Well, I guess, so I'm asking you this question, but I think I know the answer to it already. But for the future, it seems like there's some additional areas you're going to be looking into or researching to follow up on this.
Oh, absolutely. Obviously, with respect to just the NYMEX contract, we'll continue to monitor this over time, to see whether or not what we've observed in the analysis has sort of become the new normal, or if there's a switch in market structure back. But this sort of market structure analysis can be readily applied to any other number of commodity markets, whether MIB wants to take a more encompassing look at crude oil contracts, or if we wanted to pivot this over to something like refined products, or even to other commodities like corn or wheat or treasuries. Now, obviously, in those latter cases, it's a different question we're asking. The impetus is not going to be what has tight oil done to treasury markets, but these similar market structure things can be done on a wider basis.
Okay, great. All right, analyst from CFTC's MIB, Chris Goodenow, thanks for coming on the show today.
Thanks for having me, Andy.
All right, that wraps up today's CFTC Talks FlashCast. Hope you enjoyed it and can check out the research MIB has on the CFTC website. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. Thanks for listening. This has been CFTC Talks.
But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced guests in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.